Plug Power Inc. is currently trading at $2.11 USD, reflecting an intraday drop of 4.09% as of the afternoon session on Tuesday, December 23, 2025. While the broader market might be looking at this as just another volatile day for a high-beta energy name, there is an underlying story here that most retail investors are missing. The immediate expectation for a company like Plug Power is that its massive expansion into global markets, everything from the first green hydrogen facility in Africa to new liquid hydrogen contracts with NASA, should be driving the stock price toward the moon. However, the reality of the situation is rooted in a heavy capital structure and a market that is suddenly demanding proof of profit over promises of growth. While many traders using their Robinhood app or browsing investing sites see the headline deals, the institutional side is focused on the massive dilution risk and the shifting landscape of federal support. This disconnect creates a curiosity loop. How can a company be so successful at winning contracts while its stock price remains pinned near multi-year lows? When you look at the recent movement, Plug Power has been caught in a tug of war. The stock has seen significant intraday swings, often tracking the sentiment of high-growth tech like Nvidia stock or Tesla stock, but without the benefit of their massive cash flows. Just this month, the company announced the installation of a 5-megawatt electrolyzer in Namibia and a letter of intent for a project in France. On the surface, this looks like a win, but if you look at the trading volume, which has been hovering around 80 to 100 million shares daily, it is clear that for every buyer excited about a new contract, there is a seller worried about the company's cash burn. The reality that complicates the bullish narrative is the recent suspension of activities related to the $1.7 billion Department of Energy loan. Under the current administration, clean energy commitments are being reevaluated, and Plug Power had to make a tough call to pivot away from federal support to preserve its own liquidity. This is the kind of detail that seasoned investors using interactive brokers or professional fidelity wealth management services are parsing through while the general public just sees a cheap stock price. Establish common ground here. If you've been following the green energy sector, you likely believe that hydrogen is the inevitable next step for heavy-duty transport and industrial power. This belief is what fuels many online investment decisions. You might see the stock at $2 and think it's a steal compared to its history, but let's challenge that. The deeper reality is that Plug Power is currently asking its shareholders to approve an increase in authorized shares from 1.5 billion to 3 billion at a special meeting set for January 29, 2026. This isn't just an administrative move, it's a survival tactic. If they don't get this approval, they've already stated they might have to implement a reverse stock split. This creates a massive tension between the expectation of a recovery and the reality of potential further dilution. When you are doing your own self-investing or using SoFi active investing platforms, you have to weigh the technological promise against the fact that the company is effectively doubling its potential share count to stay afloat. The institutional activity tells a fascinating story. Vanguard and BlackRock have actually been increasing their stakes recently, which might suggest they see a long-term bottom. However, the daily price action is heavily influenced by short-term momentum and the cost of capital. High interest rates have made it incredibly expensive for companies like Plug to fund their massive infrastructure projects. This is why we saw the company raise $399 million through convertible notes recently. While it helped them retire high-cost debt and fully fund their current business plan, it also added another layer of complexity to their capital structure. Those using Schwab Intelligent portfolios or other robo-advisors might not see these nuances, but they are the primary drivers of why the stock isn't participating in the broader market rallies seen in Apple stock or other blue-chip names. The market is no longer giving a free pass to companies that aren't EBITDA positive, and Plug is currently aiming for that milestone in the second half of 2026. If we look at what Plug Power actually does, the business model is built around a green hydrogen ecosystem. They don't just make the fuel cells, they produce the hydrogen, build the fueling stations, and manufacture the electrolyzers. This is a vertically integrated approach that is capital-intensive. Their Gen-Drive fuel cells are used by giants like Walmart and Amazon for material handling, which provides a steady base of revenue. But the real growth engine they're betting on is their Gen Eco electrolyzer business. Revenue from this segment grew significantly in the third quarter of 2025, but it's still not enough to offset the massive operational costs. For an individual brokerage account holder, the question is whether the Project Quantum Leap, their internal initiative to streamline operations, can actually bridge the gap. They've managed to reduce their operational cash burn by nearly 50% year over year, which is a step in the right direction. But when you're still burning millions a month, the margin for error is razor thin. The sector momentum for hydrogen has been tepid compared to the frenzy around AI and data centers. Interestingly, Plug has been trying to position itself as a solution for data center power needs, aiming to provide backup energy that doesn't rely on the grid. This is a smart pivot as it taps into the massive spending we're seeing from companies that drive NVIDIA stock and Apple stock higher. If they can secure a major contract with a hyperscaler for data center power, that could be the catalyst that finally breaks the downward trend. But until that happens, the stock is likely to remain a favorite for day traders on the Robinhood app who thrive on 4 to 5% daily swings. Commentary from analysts is all over the place, with some setting price targets as high as $7 and others suggesting it could drop below $1 if the share authorization fails. This wide range of outcomes is exactly why you need to be cautious with online investing in this specific name. Let's take a second here for some community feedback. Comment below how many shares of Plug Power you currently hold, or if you've moved your capital into more stable Fidelity ETFs or other sectors entirely. It's always helpful to see where the smart friend money is flowing in real time. Moving into the business model further, the company has historical reports that show a pattern of missed expectations. For years, the narrative was about the hydrogen economy being just around the corner. Reality consistently pushed that timeline back. Today, they are operational in Georgia, Tennessee, and Louisiana, producing about 40 tons of liquid hydrogen per day. That is tangible progress. They are no longer just a research and development firm, they are a production firm. However, the cost of producing that hydrogen has often been higher than the price they can sell it for, leading to negative gross margins. The recent pricing enhancements they mentioned in their third quarter report suggest they are finally starting to charge what the product is worth, but they risk losing market share to competitors who might be more subsidized or have deeper pockets. Macroeconomic pressures are a huge factor. The transition to clean energy is heavily dependent on policy. With the current pause on certain DOE loans, Plug has had to get creative. They've been monetizing electricity rights and seeking international partners to keep the lights on. This shift from a US-centric growth strategy to a global one, evidenced by their deals in Namibia and Uzbekistan, is a direct reaction to the political reality at home. When you compare this to the stability of something like Fidelity mutual funds or a diversified portfolio on a trading platform, the risk profile of Plug is off the charts. It's a high-stakes bet on a specific version of the future. The expectation is that the world will eventually have no choice but to adopt hydrogen. The reality is that the path to that adoption is littered with bankruptcies and massive shareholder dilution. Looking ahead to 2026, there are a few scenarios to keep in mind. The first is the bull case. Plug Power successfully doubles its authorized shares without a massive sell-off, uses that capital to finish its Texas and New York projects, and finally hits that EBITDA positive mark. In this scenario, the stock could easily triple from these levels, as the short squeeze potential is enormous given the high short interest. The bear case is more sobering. The shareholder vote fails or is delayed, the company runs low on cash by mid-2026 and is forced into a predatory lending situation or a restructuring. For anyone using SoFi Invest or Interactive Brokers trading, these are the two poles of the trade. There is very little middle ground for a company with this much volatility and capital requirement. Institutional activity currently sits at 43%. This is relatively high for a stock that has struggled this much, which suggests that big players aren't ready to give up on the hydrogen dream just yet. But they are also the first ones to hedge their positions with options, something retail traders on the Robinhood trading platform might not be doing as effectively. If you're looking for investment help, the biggest piece of advice is to look at the cash-to-debt ratio. Plug has improved this, but they still have a mountain to climb. The reality of their $166 million in unrestricted cash against their quarterly burn rate is the most important metric to watch. If that number doesn't start growing through internal operations rather